Hello and welcome. You're watching an NDTV Profit special. We're currently awaiting the CPI inflation figures that will be published any minute now. I'm in conversation with Yuvika Singhal, economist at Quant Eco Research. Hi, Yuvika.
Hi, Pallavi.
Thank you so much for taking time out. So while we're waiting for the figures, what's your expectation for the headline? What are you looking at?
So for the month of April, we are expecting a headline number of 4.72, which will mark a slightly gradual deceleration vis-a-vis the March number, which stood at 4.85. And if our expectation does come true, it will also be the fifth month of moderation on the CPI series. So that would be good news, I think, broadly in terms of granularity. Some comfort on food, largely because we haven't seen the impact of the severe heat waves have a major impact in the month of April. Summer seasonality, yes, the prices have moved up, but not to the extent that we had anticipated. And the price cuts on fuel, both petrol, diesel, as well as LPG, which had happened in the month prior, that is March, the positive effects of those are likely to linger on into the month of April. So on both these counts, I think we should see a print which continues the moderation or the deceleration that I spoke about.
So retail inflation has actually come in at 4.83% for the month of April. For consumer food price inflation index, it's coming at 8.7%. Mr. Madan Sabnavis, Chief Economist at Bank of Baroda, we're joined by him as well currently. So what are your quick thoughts on the key figures, the headline at 4.83 and food price inflation at 8.7%, broadly in line with expectations, I would say?
Yeah, I think that is what I would also tend to agree with, that it's more or less on expectations of 4.8%. In fact, we had a number of 4.7%, but I really don't think it matters much. We're within the comfort of 5%, but there's a lot of discomfort that we are still well away from the 4% number. Now, I think that number which you've highlighted of food inflation being above 8%, I think that is a concern and something which will continue to be a concern going ahead, given the fact that the heat wave, which is pervading a large part of India, is something which is likely to affect the prices of fruits and vegetables. I think that is where we have already seen prices moving up in the month of May. And that will continue until we have the new crop coming in. So while the monsoon and Kharif prospects are still a way off, and I wouldn't really draw too much of comfort on what the IMD has said being a normal monsoon, because in the past we have seen that even though we have such kind of announcements, it may not necessarily translate to a good Kharif crop. But notwithstanding this, I think we are very much in a status quo-like situation and unlikely to move the needle as far as RBI is concerned when they meet next week.
Right, okay. So before we can go ahead, I'll quickly take a minute to look at some of the key figures. On cereals and products, we're currently at 8.6%. On meat and fish, we're at 8.2%. Eggs is 7.1%. Oils and fats is, again, a contraction of 9.4%. Vegetables is 27.8%. Pulses is 16.8%. Clothing and footwear is at 2.85%. Housing is at 2.68%. Fuel and light is once again a contraction at 4.24%. We're also looking at personal care and effects coming in at 7.5%. So, Yuvika, coming back to you regarding some of the specifics for pulses and products, for instance, and for vegetables, we're clearly continuing to see double-digit inflation again, fairly on expected lines. What is your takeaway just looking at some of these figures? And as Mr. Sabnavis said, we're currently on wait-and-watch mode for a lot of for how these prints evolve in the next couple of months as well, given the weather dynamics. So what are you making of these?
So absolutely, Pallavi, though headline looks broadly in line with expectations, I think the granularity of the CPI print matters a lot more. And here, I think with food inflation remaining or going back above 8%, does seem to indicate that the price pressures that we've seen on the food front continue to linger on. And this is no surprise and in line with expectations, largely because remember, well into when we were beginning the fiscal year, the meteorological department had warned us of severe heat waves through the months of April, May, and June. And this is likely to have an impact on food prices, perishables, especially fruits, vegetables, to some extent, pulses. We do find historically that the impact of heat waves is the most severe in the month of May. So while April, we might through and not seen the entire impact of the heat wave coming on board, but May and June will be extremely critical to keep a watch on. Historically, we find that in years when heat waves, a severe heat wave did take shape, that is, the maximum temperature exceeded normal temperature by almost 4 to 5 degrees, it added almost 20 basis points of momentum to perishables inflation in a single month, which essentially means that is every 1 degree deviation. So that essentially means if a severe heat wave does make an impact, it could add as much as 25 to 30 basis points to our headline estimates for this year. So it's a wait and watch game. I think the heat waves have just begun, and the full impact of it we'll have to wait and see how it pans out in the month of May. But I think having said so, I think there is also good news on the anvil in terms of rainfall outlook, which IMD pegs at being above normal at 106% of long period average. So I think that any kind of impact from the heat wave is likely to be short-lived, and we should see some bit of assuaging or reprieve in price pressures coming in once the monsoon season is in full swing, that is Q2 onwards.
Okay, all right. So coming back to you, Mr. Madan, so even looking at the RBI projections for the inflation trajectory going forward, in Q1 and Q2, we are likely to see some gradual easing in inflation, closer to the 4% target before we once again see a little bit of a bump up in Q3. And like Yuvika mentioned, we're currently on wait and watch mode. A lot clearly seems to depend on the trajectory of the southwest monsoons and currently the ongoing heat waves and how much that translates into. But given all of these factors, and I do understand that a lot of these factors are currently moving, are we still looking at overall easing in the headline supported by fuel inflation and core inflation, like even today's print seems to sort of reiterate?
You know, what's going to happen is that a lot of these numbers are statistically going to be driven by the base effects for quite a few components. So we may get this feeling that inflation is easing. But just let's remember two things. So one is, of course, the heat wave, which we have discussed. The second is that core inflation is something which is also likely to move upwards. One is, of course, the base effect. We've had very low core inflation numbers of 3%. And historically, we've seen that it's been one of the lowest phases of core inflation. Second, we've also seen a number of these FMCG companies announcing an increase in their prices. So that is something which is going to get reflected in higher prices of their final products. And what you've already mentioned, personal care products are also going with a fairly high inflation rate. That's something which is going to, and household goods, I think these are the things which are going to start increasing as we go along the way. So while the RBI had made its estimates of inflation coming below 4% in the second quarter, but I don't think at that point of time the heat wave factor was very much in existence. So today it's a reality. So it will be interesting to see in case the RBI has a different perspective or a different take on how this trajectory of inflation will behave, especially in the first and second quarters. Because I think before the monsoon, there is going to be certain pressure because of the heat wave. And then depending upon how the monsoon comes in and moves around, I think that's where we'll get to know whether we actually remain below this 4% mark or not. But we should also remember that the RBI has spoken of inflation moving up in Q3 and Q4. So in general, I think we are going to be in this 4.5% range, going by the RBI numbers. We believe it will be more towards the 4.5% to 5% range for the average, as an average for the full year.
Okay, great. Yuvika, I do want to ask you about the rural and urban inflation figures last month, and in continuing with that trend this month too. We've been seeing higher inflation figures in the rural sector for some time now. What is the reason for that, and can we expect these figures to converge going forward? Like, I'm curious to understand why rural inflation's been trending higher, even in case of food inflation, for instance. So rural inflation, the headline is at 5.43% versus the urban inflation print coming in at 4.1%. For food, rural stands at 8.75% and urban at 8.56%. And the reason I'm wanting to go into greater detail here is because we have our sights set on the rural economy, given that it was a painful year, the last year for the rural economy, and there appear to be some signs of a recovery. So what are you making together of that picture?
So I think when we look at rural and urban, dichotomy within the CPI basket, one, we need to keep in mind that the two indices are built in a very different way. So the weights are different largely because rural does not take into account housing. So while the urban side of inflation takes into account housing, rented allowances, paid towards housing or dwellings, the rural side of inflation or the index does not take that into account. So what that essentially means is that the weight on the rural side of the basket is split between the other indicators, within which food carries a higher weightage in the rural side of the CPI basket vis-a-vis the urban. And that could be one reason that given that we are seeing broad-based price pressures within the food basket, amongst which most of them are concentrated in some of the staple food items that consumers end up consuming, such as staples like cereals, wheat and rice both, pulses. So these are the components which could have had a greater share in the rural side of the basket of CPI and could be exerting a greater price pressure. So I think it's the way in which the rural versus the urban index of CPI that is constructed, which automatically, if the food inflation is running higher, tends to have a more exaggerated impact on the rural side of inflation vis-a-vis urban.
Okay, all right. Mr. Sabnavis, I'd like to get you in on that question too. I do want to get your view on what rural economy recovery is looking like. So, for instance, even as I discussed with Yuvika, and even looking at, say, FMCG earnings and commentary by a lot of these FMCG companies, while it's still wait and watch mode, it does appear like there are signs of improvement. How are you looking at it?
No, in fact, the view which I get is that most of the companies have actually indicated that while they are hopeful that the rural economy will recover and rural demand subsequently also picks up, as of now, if you're looking at the performance in fiscal 24, that is across all the 4 quarters, there's been one commonality, and that has been that rural demand has been lagging. And that is one of the factors which has been inhibiting overall growth in the manufacturing sector, especially of the consumer goods segment. So I think a lot depends upon how the agricultural sector is going to perform. Now, as far as the Rabi crop is concerned, we keep getting conflicting views. There's one view which says that it's going to be an all-time high production of food grains. There's another view saying that there has been certain crops in Madhya Pradesh, especially wheat, which has gotten affected. So therefore, even the procurement has not gone according to plan. So at the end of the day, I think the proof is whether people are spending more, whether the rural folks, especially the farmers, are spending more or not. And it does look like that we have not seen this happening in fiscal 24. And now, as you mentioned, that when your inflation is higher in the rural areas compared to urban areas, I think that tends to denude your overall consuming power. So while inflation affects everyone, but to the extent that rural real income comes down to a greater extent compared to urban incomes, there would be a tendency for consumption out there also to get affected. So I think the critical factor will be as to how the Kharif crop fares. And to my mind, I think it's a bit too early for one to judge. IMD data is a good kind of an input, but just remember it comes well before the monsoon also has arrived. And we have seen that monsoon rarely comes in June 1st. It's more towards the end of the month of June. So the other factors which would actually contribute to the final Kharif prospects. So I think even from the point of a corporate view, it looks like that the first half may not really be too ebullient. It's going to be in the second half based on how the Kharif crop works out. I think that's where we could be getting a better picture on rural demand.
Right. Okay. Yuvika, coming back to you, I do want to ask you, so we've seen IIP figures come in late last week, and by now we have some clue of what high frequency indicators for the last month are looking like. What does that tell you about the state of the economy? Is economic growth as resilient? Have we seen some slippage in terms of momentum? What's it looking like?
So broadly speaking, I think, Pallavi, the expectations that were there probably, towards the end of last calendar year or at the beginning of the year, that the economy is set to see some kind of a slowdown in momentum, I wouldn't agree with that narrative. And I think we have completely defied the broad-based expectation of a slowdown. Though we have seen in some of the indicators momentum slowing in the month of March and somewhat in April, but I would not still call it to be a broad-based trend that I would, take a bigger view on. But I still think there is decent amount of momentum that is lingering on in the economy through the months of March and April. And that's what the lead indicators are telling us. So if you look at most of the lead indicators, whether it's PMI, auto sales, if you look at a handful of other indicators like IIP, which are more volume based, we do see momentum continuing to tick in the months of March and April. And I do not see the concern of a slowdown still coming in a big way to be of a matter of concern to us. So I think there is still momentum that is continuing, and the state of the economy still looks fairly resilient to us. And the concerns of a slowdown typically that were expected about a quarter or two ago have not really manifested in any strong fashion for either the central bank or the analysts to flag it off as a red flag.
Right, okay. Madan, coming back to you, can we expect can we expect core inflation to stabilize for the rest of this year? We have seen continuing de-acceleration, we've seen core inflation continue to sort of ease, and that's helped offset the rise we've seen in food prices. But going forward, what is the interplay you expect between food inflation and core inflation?
Food inflation is going to depend a lot on the way in which the heat wave affects vegetable prices in particular, because that's something which has been a pain point for us, and how the Kharif crop really turns out. So, and of course, there's going to be the favorable base advantage, because when you're talking of making comparisons over growth inflation rates of 7-8%, it would tend to definitely get moderated. On the other hand, if you're looking at core inflation, as I mentioned earlier, there are definitely signs that for the manufactured products as such, there have already been price increases which have been invoked, say washing powder, detergents, soaps, other kind of toothpaste. The prices have already started moving up in the market. And that is something which is going to get reflected in core inflation. So we have a situation where core inflation is moving upwards. Definitely not to any pernicious limits. They'll probably still be in the region of around 3.5%. And we'll probably have the food inflation number moving downwards. And given the fact that the kind of fear which we had about fuel prices, about crude oil price going up to $100 on account of the Israel-Iran war conflict, has actually been now once again been held back. And crude oil prices are going to remain largely neutral in the region of around $80 per barrel. I think this number of 4.5% to 5% inflation will persist for this particular financial year. So the important call is as to, in terms of rate action, as to how would this 4.5 to 5 number be viewed by the MPC members, whether they think it's good enough to reduce the repo rate or to keep it at the level. Today, if I look at the OIS rates, it does look like we're talking of 6.75% still. So maybe the market is still a bit cautious about thinking of any kind of rate action at this point of time.
Right. Yuvika, I do want to ask you about the MPC trajectory as well going forward. We're currently on wait and watch mode, but when are you guys sort of penciling in the first rate cut, and do you even see one happening anytime during the course of this calendar year?
So right, Pallavi, I think both growth and inflation dynamics have to be looked at closely in this year, largely because we have seen growth being more resilient than was envisaged, as I spoke about earlier. And inflation, I think there are some known unknowns on the anvil, especially with respect to the heat waves, and then the monsoon, how it pans out. Though we likely to see a surplus outcome, but we also have to see how the monsoon distribution is, spatially, geographically. Also, there are concerns in some pockets that if monsoon indeed is above normal, or is at 106% of long period average, can it also have some negative impact if it comes at the wrong timing when the crop is standing and is ready for harvest? So we'll have to wait and see how this monsoon season actually pans out. So I think the rate action will be backloaded in this calendar year. It will anyways be a shallow rate cutting cycle is what we are thinking at this point in time. Probably the first rate cut could come in as per our expectations in the month of October. A 25 basis points cut is what we are anticipating at this point in time, followed by another 25 basis points likely in March next year. So probably we are looking at just 50 basis points. That is why I say it could be a shallow rate cutting cycle, just of 50 basis points in this fiscal year, given that we are seeing resilient growth and there are some known unknown risks on inflation. Though I broadly believe that inflation is expected to trend lower, we are pegging the full year inflation forecast at 4.5%. So broadly, while Q1 could see inflation figures, especially the next 2 months could see inflation go back above 5%, the months of July and August could be fairly benign, largely because of extremely favorable base effects coming in from last year when we had seen a tomato price spike in this almost the similar months. But beyond August, between September to March, we could largely see inflation hovering in the range of 4.5% to 5%. So while on an average for the year, it could still be at 4.5%, but yet again, we are not in line with the target of 4%. That could still be a wait story for the next, that is a subsequent 12 months, that is for FY26, that we'll have to wait and see inflation align to a 4% target, possibly over the course of the next 18 to 24 months and not the next 12 months.
Okay, all right. Thank you. That was very comprehensive. Madan, coming back to you, I do want to come back to the same question that I'd earlier asked Yuvika as well. What are you making of high-frequency indicators at this point? While there are clear signs of resilience in economic activity, is it also a little bit of a mixed picture now? For instance, again, coming back to rural, for instance, tractor sales have not been particularly encouraging, but at the same time, rural wage growth seems to have gotten a little better considering what we've seen the past couple of years. So all in all, is it still a slightly mixed set of indicators that we're looking at, or is recovery broad-based?
You know, we at Bank of Baroda, we are actually looking at a GDP growth in the region of 7.5% to 7.8%. for this particular year. It's probably on the higher side of all other estimates which are there by my colleague economists and analysts. So therefore, we are bullish about India. Now, this said, I would say that one has to be very cautious while reading these high-frequency indicators, because we have been misled very often when we look at these numbers. For example, if I do a comparison of the PMI numbers, which is very often quoted, you compare that with the RBI's business expectations things, I mean, the two of them move in a different direction. So I think we'll have to use a bit of judgment when you're looking at high frequency indicators, especially based on surveys. I would go more along with the absolute numbers like the IIP, which comes out. We have seen that even things like GST has been quite misleading, because GST collections have been the best last year, but yet we have seen a major pain point has been consumption. So we have a case of saying nominal consumption going up but not real consumption because of the inflation factor. So I think the two problems which we have had are not really addressed by the high frequency indicators. One is about consumption. I think we have spoken and discussed a lot about rural demand, rural consumption. So that remains a thing which has to revive. So second is private sector investment. Okay, so while we have the steel companies who have increased their capacity because of the positive impact of government expenditure leading to greater demand for their products, same thing is happening in the cement industry. We're not really seeing it in the consumer-based industries. So it's a kind of a mixed picture. That's what you have asked in the beginning, Pallavi, that it is a kind of a mixed picture which we're getting. We are positive right now based on the assumption that there's a recovery in the rural demand on account of the good monsoon, good Kharif crop, good Rabi crop. That's the reason why we are pitching at higher GDP growth for this year compared to last year. At least maintenance of that 7.6% growth is something which could be done. But the primary assumptions are that consumption and private sector investment, these two factors to recover. In case they become shaky, then I think our estimates will also have to be revised downwards.
Okay, all right. Now, Yuvika, we've touched upon the heat waves and the southwest monsoons and how these are possibly indicators that will sort of determine the course of inflation and possibly the economy going forward. What are the other sort of key events, like especially considering, that we've been talking about resilient economic activity, GDP possibly once again surprising on the upside in Q4 as well, and sort of resilient economic activity in the ongoing Q2. What are the events that you're going to be watching out for? Is the next big one then the budget maybe?
So I think as far as growth is concerned, I think the story this year would be that we need to move our attention away from GDP towards GVA. Because if you will remember last year, there was a very sharp gap between GVA and GDP numbers. And the GDP numbers were in some sense, inflated because of what was happening on the net indirect taxes, that is indirect taxes minus subsidies front. So this year, to actually compare to understand the correct state of the economy and how the economy is performing, looking at GVA, which captures the economic activity far more better than GDP from a statistical perspective, I think we need to focus more on GVA. And I think there we somewhat differ in our views from Madan sir, where we do expect the economy to see a slowdown, not just in GDP terms, but also in GVA terms. So while the extent of moderation in GVA is expected to be smaller in our assessment, just about 50 basis points. So from 7.1, we are looking at GVA correcting to about 6.8. But there is bound to be a slowdown. And why we expect this slowdown to come in is largely because the support that was there last year to the manufacturing sector GVA from commodity prices, it's completely going to wane away in this year. With WPI moving from deflation of close to -1% to a positive number of 3%, there is bound to be support that is going to get exhausted in FY25, largely because from a price perspective. So there is likely to be some moderation in the GVA and the GDP as well, though we do expect agri to be an outperformer this year, backed by better than expected monsoons. Last year, we saw a below normal outcome. Now we are expecting an above normal outcome. So there is bound to be a smart recovery in agri sector, though we do feel that services could see some bit of normalization. The post-pandemic normalization in demand is something that has been taking shape in the last few quarters, and we expect that to continue. Just to wrap up on consumption, we are somewhat a little bit more skeptical on the strength in urban consumption continuing at the pace that it was in FY24. So we do see some degree of moderation setting in there, right. But rural consumption backed by good monsoon, some improvement in rural wages, continuing support from fiscal policy, we do expect that rural consumption could on trend move slightly on a stronger footing compared to last year. So that's right. Essentially what we are broadly looking from a growth perspective. And in terms of events, I think, yes, the right. budget will be a very important closer to home event. But besides that, I think we need to keep a close watch on geopolitics and geopolitical conflicts that are right. Raging in the world, and they have a serious implication for domestic manufacturers, inflation, rupee volatility. And I think that is one other factor that we would keep right. a close watch on.
Okay. Well, with that, we're completely out of time. But thank you so much, Mr. Sabnavis and Yuvika, for an extremely wholesome discussion. Thank you so much for watching. Stay tuned to NDTV Profit. We have a lot more lined up.